Good morning. My name's Mark Molesworth. I'm a tax partner with BDO. I'd like to welcome you along to this second webinar in our series of COVID-19 webinars. And this morning, we're going to talk about the government's tax stimulus packages and some changes to the insolvency laws and the, uh, the concessional loans which the government and the commercial banks are making available to businesses. Um, we intend these webinars to be short and punchy. We understand that business owners will be having a lot to do at the moment, hence the slightly unsociable time of 7 o'clock in the morning, but also we intend this to run probably about 45 minutes with about half an hour of presentations and 15 minutes for questions afterwards. Thank you to those of you who have provided us with questions in advance of the session. We will do our best to answer all of those during the question and answer period, if they're not actually answered during the presentations themselves. But there is a question box on the program which we're using to run this webinar. Please feel free to type those in. Because of the work from home arrangements that BDO is working under at the moment, the presenters and the people running the presentation are all in very different spots. So bear with us if we don't get to your questions. You will hear different people asking questions depending upon their role in this broadcast, but we're trying to hold this all together with sticky tape and glue, and hopefully you get a whole heap of interesting information out of it. The webinar is being recorded, so if you do happen to miss anything, if you want to go back, or if you need to drop off because your family needs you, please feel free. It will be available on the BDO website on our dedicated COVID-19 page after this broadcast, but anyone who's registered for the broadcast will also receive a link to the recording of the webinar at the end. So without any further introduction, I'd like to show you my co-presenters today. Darren Stacey is an executive director in our debt advisory area. Now, Darren is a career banker. We try not to hold that against him. He has a lot of information and a lot of wisdom from many years in the banking industry, which he uses to help our clients navigate their way through dealing with banks and other financial institutions. And we also have Charles Haynes, who's an associate director in our business restructuring area. Now, you can meet good Charles or you can meet bad Charles. The Charles we're meeting this morning is good Charles. Good Charles will help businesses who think they might have some issues with solvency, who think they might have some issues with meeting their ongoing obligations, and help them to plan to get through that. Bad Charles is the person who turns up once the business is hopelessly insolvent and then asks you for all your assets. We don't want to meet Bad Charles. That's why we're talking to Good Charles this morning. But first of all, I'm going to have a quick run through the taxation stimulus packages, because both the federal government and the Queensland government are delivering a large amount of the assistance to business, which they see as being required through the taxation systems. And so if you bear with me for about the next 15 minutes, we'll have a look at the different elements of those stimulus packages, who's eligible for them, and what some of the not so good news about those stimulus packages is, because unfortunately there is in some circumstances for some people some not so good news about access to the stimulus packages. So the element of the stimulus package that has probably received absolutely the most coverage, both in terms of the questions that I'm receiving and also the information which is being made available by the government, is the so-called cash boost for business. So this cash boost is available to businesses which have an aggregated turnover of less than $50 million, based upon information that the tax office holds from the last time that you lodged a tax return. Now, you'll notice the word aggregated. So when tax people talk about aggregated turnover, we're not talking just about the turnover of the entity involved. We're also talking about the turnover of any other entities connected with that entity. Now, connected with is a really technical term. It gets really complex, but ultimately, to, to simplify it, if you have a 40% or greater control interest in an entity, then you're connected with it. So if I've got one company that owns all the shares in the next, those two companies are connected. If I personally own all of the shares in company A and all of the shares in company B, then me and company A and company B will all be connected. So our turnovers will all be aggregated for the purposes of working out whether any of us can claim this cash boost. If you get through the aggregated turnover hoop, then the way that the cash boost is calculated is by reference to the pay-as-you-go withholding liability. I've summarized it there because tax people love acronyms, to PAYGW liability. The way that this is going to be paid requires, as far as we're aware, no action on the part of the business involved other than lodging your business or your installment activity statement. Because the way that this payment is designed is that it's split into two boost payments. The first boost payment is a minimum of at least $10,000 for people who employ anyone and pay wages, and a maximum of $50,000. It's calculated by reference to the pay-as-you-go withholding amount that is reported on your March BAS. So it's the payment is calculated as, forgetting about the minimum and the maximum, the payment is calculated as 100% for a quarterly BAS lodger, 100% of the pay-as-you-go withholding reported on the March BAS. And for a monthly BAS lodger, it's calculated as 300% of the amount on the March BAS. So at the time that you lodge your March BAS, the tax office will calculate automatically, based upon the numbers on that business activity statement, what your amount of boost is, what amount of boost you're entitled to. As I say, there's a minimum and a maximum of $10,000 and maximum of $50,000. The intention is that the boost will be paid in April, very promptly after the business activity statement is lodged for March. If you haven't already maxed out your first boost payment by lodging your March business activity statement, then you can continue to receive further first boost payments based upon the pay-as-you-go withholding in your April, May, and June BASs for monthly lodgers, or in your June BAS for a quarterly lodger. So depending on what your payment cycle or your withholding cycle is, you may get further additional payments, assuming that you haven't maxed out the $50,000 when you lodge your March BAS. So that's the first boost payment. It's calculated by reference to the pay-as-you-go withholding on your March BAS and then on your April, May, and June BASs, assuming you're lodging monthly, or on your June BAS if you're lodging quarterly. The second boost payment is then calculated as exactly the same amount as you received under the first boost payment. So there's nothing further that you have to do. It's going to be exactly the same amount, and it will be paid in 4 installments in June, July, August, and September of 2020. So that's how the cash boost is going to be calculated. Businesses, as far as we're aware at this point, don't have to do anything other than lodging your business activity statements, reporting correctly your wages paid and your pay-as-you-go withholding, and the tax office then goes ahead and does the rest. The issue with the cash boost payment is that I think it's a bit of a so-called cash boost payment. Now, I would stress there's not a lot of data about this at the moment, and I think the tax office is still working out exactly what it's going to do. But the indications in the legislation are that the cash boost payment will be paid as an offset against your running balance account. And your running balance account is your account with the tax office that accumulates all of the information about what you owe the tax office other than in relation to corporate income tax. So it accumulates all of your GST liabilities, all of your pay-as-you-go withholding liabilities, and all of your pay-as-you-go installment liabilities. Now, the issue here is that the tax office is offering some quite concessional deferrals for payment of those liabilities. So, the tax office, for example, is offering a deferral of up to 6 months for uh, GST liabilities. It is also the case that potentially you already have a payment arrangement, a debt arrangement in place with the tax office in relation to previous debts. The issue is that if you have any other debts in your running balance account, it would appear that the legislation indicates that the boost payment should be offset against those liabilities, even if they're the subject of a payment arrangement so that they're deferred. Now, that doesn't seem to really accord with what the government was trying to do, which was to get cash into the hands of businesses to allow them to continue to pay staff. So that's a little bit bewildering to me. It remains to be seen exactly what the tax office says it's going to do about that, and whether it receives a change of mind direction from the government, shall we say, to actually pay these cash boosts in cash. The other thing that you need to be able to show in order to be eligible for the cash boost payment is some sort of lodgement. You must have lodged some document with the tax office between the 1st of July 2018, or relating to a period between the 1st of July 2018 and the 12th of March 2020, usually in relation to the 2019 financial year. So in other words, you've got to either have lodged your 2019 income tax return, and it must show some sort of business income, or you must have lodged a business activity statement relating to some time in that period from the 1st of July 2018 onwards, which shows that you've received consideration for some sort of supply. Now, there's probably a couple of issues with this. The first is that if you're an annual GST return lodger, you may not have actually hit the due date for any of those documents yet, because they're typically not due until the 31st of March or the 15th of May. The second thing is that if you're a pre-revenue business, so you're purely in a startup phase and you don't have business income, then you may have lodged all the documents you needed to lodge, but they may not actually show income from a business or consideration received for any supply. So there are going to be some businesses that fall through the cracks here because of this requirement that is in the legislation that says you've got to have, um, in essence, an operative business, and you must prove that you've had an operative business by lodging these documents in at some point over that period of about 15 months. The other thing, which is or the other type of business here who is not going to get the boost, is potentially a business that started up or was acquired sometime after the 1st of January 2020, because in those circumstances, you will not have had to lodge anything before the 12th of March. So new startup businesses are not getting support out of this cash boost, where potentially they should be the ones who are most at risk and most eligible. The other elements of the stimulus package that are being delivered through the tax system all relate to depreciation, and they all relate to attempting to incentivize businesses who have the ability to go out and buy new assets to go and do that, to try and stimulate the economy. So whilst the cash boost is designed to put cash into the hands of businesses directly from the government, these are designed to incentivize businesses that have cash and are not in a situation where they need to preserve cash. It's to incentivize them to go out and spend it on assets. So there's been an extension of the instant asset write-off. It currently applies to assets costing less than $30,000 for businesses with an aggregated turnover of less than 50 million. It's been extended to businesses with an aggregated turnover up to $500 million, and for assets which cost up to $150,000. So where you acquire one of those assets and it's first used or installed ready for use between the 12th of March and the 30th of June 2020, so a period of only 3.5 months. But in that, if the asset is first used for income producing purposes in that period, then up to $150,000, if its cost is up to $150,000, the business will get an immediate tax deduction in that year. For those businesses or for those assets that don't qualify for the instant asset write-off, there's the business investment incentive. Again, the aggregated turnover limit here is $500 million. The asset, the time period to which it relates is slightly longer. It's for assets first used or installed ready for use between the 12th of March 2020 and the 30th of June 2021. So it extends by another 12 months out to 30 June 2021. Interestingly, it only applies to new assets, so they must be brand spanking new, they can't be secondhand. And you must not have entered into a contract or for their acquisition or their construction before the 12th of March 2020. So it's only for absolutely new commitments to expenditure after the 12th of March. The assets have to be for use in Australia, principally in a business. So in other words, if we're talking about assets to put in a passively held rental property or assets to be used offshore, they won't qualify. The benefit here is that you get a 50% claim of the cost in year one. So in other words, rather than instantly writing off the whole cost of the asset, you get to write off half the cost of the asset immediately in year one when you acquire it or have it installed ready for use. And then you also get the ordinary depreciation, assuming that the cost of the asset has already been reduced by 50%. So in other words, you get 50% up front, and then you depreciate the other 50% of the cost of the asset using the normal rules of depreciation. There are a few other elements of the stimulus package which are broadly linked to tax. I'll just run through them now, and this is from the federal government. For small employers, so employers with fewer than 20 employees who have apprentices or trainees, the government is going to pay those entities 50% of the wages of those apprentices and trainees from the 1st of January 2020 to the 30th of September 2020. So that is actually a cash subsidy. It will also be available to large businesses if they re-employ an apprentice or trainee who's been sacked by a small employer. So in other words, if the apprentice or trainee was with a small employer who had fewer than 20 employees, they find that that business can't go on, they let the apprentice go. A large business who then re-employs that apprentice or trainee can get the benefit of the cash incentive from the government. For those people who are stood down from their jobs or have a reduction in the required hours of work of at least 20%, or for those who are sole traders and therefore are not employees, but where their income decreases by more than 20%, all of those types of people can get early access to superannuation. Now, there are various questions which really a financial planner needs to answer in relation to whether that's a good idea or not. But for people who are struggling to survive and who need the help and have the balance in their superannuation, where they're in that situation where their hours of work or their gross income for a sole trader has reduced by more than 20%, greater than or equal to 20%, they can get access to their superannuation fund to pay $10,000 to them before the 30th of June and $10,000 to them after the 30th of June. So $20,000 in total, but it will be the subject of two applications, one before the 30th of June and one after. There are also concessional loans available from the federal, essentially guaranteed by the federal government, available through commercial banks. I'll let Darren talk about that in a moment. I just want to deal with the Queensland government payroll tax benefits at this, just before we move on to that though. So the Queensland government has announced that for employers whose group pays $6.5 million or less in wages, Australia-wide, so this is not just in Queensland, it's Australia-wide wages, those businesses will be entitled to a refund of payroll tax for 2 months, which we believe will be the months of November and December 2019. They will then get a payroll tax holiday for 3 months. That is, they don't have to pay any payroll tax. And we believe the payroll tax holiday months will be January, February, and March 2020. And then anything that's left to pay in the 2020 calendar year, so presuming that the holiday is those first 3 months, the payroll tax, which is due between April and December, all of that will be deferred out to at least January 2021. This seems to be a bit of a moving feast. There is an indication that it might be February, but in any event, not until early 2021 will the rest of the payroll tax for the 2020 calendar year be payable. For employers whose group has more than $6.5 million in taxable wages Australia-wide, and where they can prove that they've been directly or indirectly affected by the virus. And just as an aside, with the number of unemployed people being made unemployed, it seems highly unlikely. With the number of people being made unemployed, it seems highly unlikely that any business will not be somehow affected by COVID-19. So those businesses will get a refund of payroll tax for 2 months, and then a deferral of all payroll tax for the 2020 calendar year out until at least January 2021. So they only get 2 months off their payroll tax as opposed to 5 months for the smaller employers, but both groups get to defer any payroll tax that is actually payable for the 2020 year out until early 2021. For employers in both categories, you have to apply to the Office of State Revenue. You have to go onto their website, click the link, and apply. Now, the link to that link is on BDO's dedicated COVID-19 website. So feel free to go and have a look and have a play around there. There's also a concessional loan scheme being operated by the Queensland Government through an organisation called Curida. But I'll let Darren talk about that because Darren Stacey is up next to talk about the support that the Australian banks are offering and also the support that the governments, both federal and state, are offering through concessional loans. So Darren, please take it away.
Thank you, Mark. And just to go through the initial support that the banks have offered, all Australian banks regulated by APRA are required to proactively consider hardship requests from any of their clients. And as a result, all of the banks have already come out on their websites and put in place a whole lot of schemes around supporting businesses who are in trouble, and most of that relates to those who have borrowed money from banks. And so where you do have a loan, you will be able to apply for deferring your loan repayments. Normally that would be 3 months, and in this scenario though, the banks have now expanded that out to 6 months. That would apply to both businesses and individuals. Some banks have said, well, you'll get 3 months initially and then we'll give you another 3 months in a couple of months' time when we recheck on you. But in general, most of them should give you the full 6 months available. Some banks have also come out and announced that they are cutting interest rates. Now, that's quite difficult to test because, as you will have heard, the Reserve Bank has come out and cut the cash rate, and so most bank interest rates are going down anyway. So where the banks have said we are cutting your interest rates, it's hard to know whether or not that's additional cuts on top of the Reserve Bank, or whether they're just passing on what the Reserve Bank has offered. But in any case, you should see your interest rates come down. Many banks have offered to extend loan terms. Now that's a difficult one for businesses, because if you're in the last couple of months of a loan and you were either commencing discussions with your bank about extending that or about to commence, those are the scenarios where I would imagine banks will push out your loan maturity or your loan termination date. If you have a loan that is already 5 years out or longer, it's unlikely that the bank is going to move swiftly to extend that loan termination date. It's mainly for those, I think, where the termination dates are quite close. Almost every bank has offered merchant terminal fee waivers. So for anybody who collects credit card payments, you can apply for fee waivers and they will be granted, as I understand it, almost across the board. So that is an easy one. And then many banks have also come out and said, look, where we would normally charge you a fee to have an increase on your overdraft, or to have a temporary excess, or perhaps to have a new equipment finance loan, in those circumstances, especially because of this COVID-19 crisis, we will waive the fees associated with that. That is not universal though. You'll need to check with your bank in relation to their stance on those particular products, and there will probably be some limitations. I can't imagine the banks will just waive every fee on every product. That's great if you have existing bank facilities or you have loans with banks. That's the sort of support they'll give. But there's lots of businesses who need more than that, or they don't have loans, but they're still going to be in some form of cash crisis. And so there is working capital assistance. Obviously, the deferral of a loan repayment is part of a solution to providing working capital. As I said, most banks are offering temporary increases on overdrafts. From my discussions with individual banks, I anticipate that they are also willing to provide temporary overdrafts for people who have business trading accounts, but where they don't normally have a limit. So they would allow potentially you to create an overdraft where you don't already have one. And that leads into this government announcement on partially guaranteeing loans up to $250,000 on an unsecured basis for businesses. Care needs to be taken here. If you already have a loan from a bank and you ask for an additional $250,000, it is likely your existing bank documentation will capture the extra indebtedness, the extra $250,000 within your existing security. So while you think the bank may be giving you an unsecured loan for an additional $250,000, it is likely your general security agreement, your GSA, will already capture it. And from the discussions again that I've had with banks, most of these loans are being considered where banks already have a lending relationship with a client. So there may be some scenarios, as I mentioned before, where you don't have any loans, but you have a business trading account. The bank will give you an unsecured loan. That's great. The government will provide some security to the bank to back that up, but you will still owe the money. And yes, potentially you won't have to provide security for it. But for those already with a debt, it's likely to be captured. Unfortunately, very few banks have provided a lot of detail on that. And I think they're still trying to work out how they're going to do that and how it's going to flow through to their clients. What we have seen, though, is QRIDA. So in Queensland, that's the Queensland Rural and Industry Development Authority. That's a state government arm, and they already administer grants and loans, especially to farmers or those battling bushfires or the drought. This arm of the government is providing loans up to $250,000 for businesses to pay wages or to cover costs. Their lending criteria just came out yesterday, and it is available for almost any purpose a business has, except for capital works or capital expenditure. So if you want to buy equipment or expand your existing warehouse, this loan is not available for that, but it is available to pay rent or wages or almost any other costs. The criteria that we've seen yesterday come out from QRIDA says that any loan under $100,000 is provided unsecured, so no security would be required. But any loan above 100 and up to 250,000 will require a GSA. Now, for those who already have an existing relationship with a bank, this security is going to rank behind your existing bank. What we have seen, though, is that there is a calculation as to how much you would be eligible for, and it's based on your wages bill over the prior year, or an average of your wages bill over the prior 2 years, if it fluctuates. So if your wages bill has been $500,000 or more, you can apply for the full amount, the full $250,000. We're yet to see any of these loans approved because it only just started yesterday, but we understand applications are going in and they will be on a first come, first served basis. So on that note, I think that's a summary, Mark, of the banking assistance that's available for businesses.
Thanks, Darren. I'll cover off some of the recent changes in the legislation around in the insolvency area and also go through some practical tips as we're seeing it for operational cash flows at the moment. The area of insolvency hasn't been immune to recent fast-paced legislation changes by government. In particular, over the last week, there have been changes to what's known as the safe harbour legislation, and also
Sorry, we seem to have lost Charles there for the minute. Hopefully he gets back very soon. Otherwise, you may have to listen to me talking about the insolvency regime, which will impress no one, I'm sure. All right, we'll see if our organizer can get Charles back on the line. Until then, there is pre-existing safe harbour legislation, as Charles was talking about, which allows businesses who think they might be running close to insolvency to essentially put in place a restructuring plan by a professional advisor, which then gives them some protection against insolvent trading actions. And so the directors are then protected against insolvent trading actions. The temporary safe harbour that Charles was going to speak about is an extension of those safe harbour rules in effect to all companies for debts incurred over the next 6 months, where directors will not be subject to certain exclusions, held liable for those the incurrence of those debts on the basis of insolvent trading. I think Darren might be better placed to talk about the rest of this for me. So,
Sure.
Darren, could you pick that up?
Thanks, Mark. You're right, though. The changes to the safe harbour legislation has given directors some further flexibility to avoid potential claims against insolvent trading. We have to be clear to note that these any debts incurred over the next 6 months have to be in the normal course of business. So that could include taking out additional debt from your bank to cover wages and employee costs. It is probably unlikely to cover directors if they embark on a massive expansion plan or undertake large acquisitions. What that has done, though, is obviously provided directors the ability to carry on without the need to put their businesses into a formal administration, where they might otherwise have done so with the risk that they would be hit for insolvent trading claims. As a result, we see a whole lot more businesses willing to carry on, but obviously in order to pay businesses, to pay their staff and to pay their business expenses, they're going to need some support either from the government or from their bank or the ATO in terms of all of the things we've just discussed. But in many cases, they also need to look at their operational costs. For many businesses, that includes the rent that they might pay to their landlord. We know a lot of people are engaging with their landlords to have rent relief. We're also seeing them look at their cash flows to make sure that they're capable of meeting the minimum costs that they have to meet and minimising expenditure in any other areas.
Hi, Darren. Sorry, I'm back on.
Excellent. So in relation to the operational aspects that we're seeing businesses undertake, we've seen a lot of people come through to us as their accountant, but no doubt they'll have other advisors as well, legal advisors perhaps, to understand how they can make quick changes to their businesses to ensure that they can make it through this difficult time. We don't know how long this will last, but they need to have a plan, and they need to ensure that they can move quickly if things change. And unfortunately, over the last week, things appear to have gotten harder, not easier, for most businesses. And they just need to continue to monitor as they go along and keep their stakeholders engaged, be it their bank, be it their creditors or their suppliers. So that's probably just a brief summary. There is a lot more to unpack in the insolvency regime, but obviously we hope that our clients aren't at that point, but it's about early engagement, I think, with all of the people that matter to your business.
Cool. Thank you very much for that, Darren. And our apologies for the small technical difficulties that we appear to be having there. As I say, we're in 4 different locations bringing this webinar to you, so bear with us. I think it's time for the question and answer session, and we have Charles back now. So the question that has been asked that several times, Charles, that I think you would be best placed to deal with is okay. We've seen the information on the new safe harbour and so on and so forth, the changes to the insolvency laws. How exposed do you think directors are at the moment?
Well, in assessing the new safe harbour laws, it's also important to touch back on the existing safe harbour laws that were in place. One of the benefits of the safe harbour laws, which were brought in place in 2017, was that it provided protection for directors for developing a plan that would reasonably lead to a better outcome than immediately placing a company into some form of external administration. Now, one of the strengths of those changes was that they required directors to include an appropriately qualified person under those changes and document a plan with steps of action that would reasonably lead to that turnaround. So while the insolvent trading regime exists in the Corporations Act, it's never heavily been used. And the safe harbour protections provided directors a plan for how to attack those potential risks. Now, there is the provisions that are now in place which came into effect on the 25th of March, so they've been in effect now for 2 days, where there's protections for directors for debts incurred in the ordinary course of business. Now, there's not much guidance yet in relation to what's defined by ordinary course. The guidance notes provide a couple of examples, which include a director taking out a loan to move some business operations online and debts incurred through continuing to pay employees during the pandemic. So these are the only 2 bullet points of guidance which are provided so far. However, in looking at these in context, it appears to be a fairly wide scope for a definition of what an ordinary scope will be. But I think it's also important to realise, as it stands currently, we now have 2 different safe harbour regimes in place. And it may be a case that as we progress in the coming weeks and months, that directors may choose to go to the original safe harbour provisions for the protections afforded under that, or in addition to the temporary safe harbour provisions, which only go for 6 months. So it very much will be a case-by-case basis as we all work through this, but it may be a case that there is some really strong protection there for directors by using the temporary measures which have been brought into place, but also relying on the existing safe harbour measures and following the guidance and rules in that respect.
Thanks, Charles. Great that you got back to us, and thank you for that really detailed answer. I appreciate it. Darren, a question for you from Suzanne, which really boils down to, do you think that startups and scale-up businesses that are heavily investing in growth and therefore in a loss position will be eligible for the QRIDA loan schemes?
That is a great question. On face value, they don't meet one of the tests, which is that they need to be profitable in the ordinary course. However, we have seen examples where QRIDA in the past have taken, again, a broad view on acceptability under their schemes, because their view is that they would like to try and help any businesses that are genuinely in need. It would be probably very difficult to raise that argument for a business that's pre-revenue, where they're not making any revenue at all. But if they're starting up and they are genuinely looking like they will be a profitable business, I think that's reasonable. Obviously, if they're employing staff, that's one of the minimum requirements for this loan under QRIDA. They have been asked to provide 2 years of financials, so that would imply that they need to have been going for at least 2 years. That would appear to knock out some people potentially.
Thanks, Darren. Really appreciate that answer as well. A couple of questions have come through that deal with the tax side of things. A question from Candice um, asks about the guidance talking about businesses having to call the tax office to determine whether you're eligible for certain support. And what do we think the factors are that the tax office will consider regarding eligibility? In terms of the stimulus measures that pass through legislation that we're looking at today, there is no requirement for the tax office administered parts that you are necessarily can show you're affected by COVID-19. The stimulus measures are available to everybody who meets the criteria, and being affected by the virus is not one of those. However, in order to obtain things like debt deferrals, and the tax office is offering, as we said earlier, up to 6-month debt deferrals for businesses that are affected by COVID-19. You do have to ring the tax office and explain to them why you have been affected by COVID-19. Our experience, and remember this experience has only been over about the course of the last 7 days, our experience is the tax office is being very understanding about that. That's not, to put it bluntly, we're projecting to have an additional 1 million people unemployed. It's not hard to show that most businesses are going to somehow be affected by the economic conditions that have been brought on by this virus. So the tax office is being very understanding about that. A related question from Sandy talks about, well, while the Office of State Revenue in Queensland is going to extend the payment deferral for payroll tax, what's the implication of not paying taxes on time, for example, in other states where that deferral concession might not be available, or indeed, I imagine, to the tax office? The answer is that most revenue authorities in these circumstances are going to be very understanding about the cash flow impacts on business. But all revenue authorities want to make sure that you remain in contact with them. So what that means, and the advice that we're giving to the businesses we work with, is that means you need to make sure that you continue to lodge whatever documents you need to lodge on time, whether they be payroll tax returns, whether they be business activity statements. You have to keep reporting what your liabilities are. The discussion can then move to, well, when are you going to expect me to pay those liabilities? And as long as you have that conversation with the tax authority, what we're finding at this point in time is they're being very understanding. As I say, the tax office is giving a 6-month deferral and then entering into payment arrangements at the low interest rate that the tax office can charge, which is about 3%, as opposed to the high interest rate that the tax office can charge, which is about 9%, and allowing extended periods of time to pay.
Sorry, Mark, just on that, if businesses want to use the safe harbour provision, the standard safe harbour provisions, keeping your tax reporting up to date is one of the prerequisites for the standard safe harbour as well. So if you want to keep that option open for down the track, it's important that all taxation lodgements are kept up to date.
Thanks, Charles, and thank you for reminding me of that. I had forgotten to mention it. So that has really dealt with most of the questions we received before this presentation began. Darren, I think you're in control of the questions that are coming through, if any are coming through. Have we received any questions from other people?
Thanks, Mark. There have been some questions. Some talk to superannuation access, and I don't know if you know.
I'll give it a shot, Darren. I'll give it a shot.
Yeah, just ask if there's an age requirement.
For the $10,000 access to superannuation, there is not. The criteria around that is that you must have had a reduction in your working hours or your gross revenue of 20% or more. Once you tick that criteria, we understand that the application for release of the superannuation benefits will be made through the MyGov website, assuming that the government can get it up and operating. And so that application we made, the that will then fall to the tax office to send a release notification to your super fund, and your super fund will then pay the money directly to you. That release, the $10,000, potentially 2 installments of $10,000, is tax-free, which is unusual for money coming out of superannuation for people under 65, but it is tax-free for everybody.
And maybe one last question, Mark, which again I think is probably for you. This is a question from Kelly, and it relates to the minimums and maximums of the cash boost payments. And it says that her question was that if a business only has less than 10,000 in pay-as-you-go withholding for the March quarter, does that mean they get the minimum payment of 10,000?
Yes, that's absolutely correct. So they'll get a minimum payment of 10,000 when they lodge their March quarter BAS, and then if the March quarter and the June quarter in aggregate are more than $10,000, their first boost will be the aggregate of those two quarters PAYG withholding. So in other words, if they were $7,000 in the March quarter and $7,000 in the June quarter, their first boost payment would be $14,000, which would be received 10 and 4, because the 10 would be the minimum and then the 4 would be the top up to get them to the right amount. And then their second boost payment in that example would be another $14,000 paid in those 4 installments of 25% each. So potentially that business, the minimum any business who's employing staff should receive is $20,000 received over a few periods, but the potential is that it might be more than that. If that's all the questions, thank you, Darren, and thank you to all my fellow presenters for their assistance with this. We apologise for some of the small issues that we're having with being not in the same room and having a few technology problems. Hopefully you obtained some value out of this presentation. This is a series of webinars that we're running on topical issues that are meant to be short and punchy and give you some information. There's much more detailed information on our website. I'd encourage you to go there. The recording of this webinar will be available both on our website and also will be distributed to all attendees immediately after the webinar. Thank you so much for your attendance. We really appreciate you taking the time out of your busy days to listen to us. If we can help you with anything, feel free to get in contact. Our contact details are all on the slides that have been provided and will be provided again this morning. Thank you very much for your attendance. Good luck with your businesses. Stay safe and stay well, and we'll talk to you again soon.